Okay, Sam, so the first question we got, a very basic one. What is a tax bracket?
It's a good place to start, right? Like, let's actually just figure out what we're talking about and the lay of the land. So a tax bracket is what determines the different rates of tax that apply to different levels of income. So someone who's earning $200,000 is in the top tax bracket, and someone who earns under $18,200 is in the bottom bracket. So at a very top level, people who earn more pay more tax, although this isn't always true in practice because of deductions, other exemptions. We're going to talk about that a bit later. But for this reason, we call our income tax system a progressive system because you pay progressively more as you earn more.
And so you mentioned there the bottom bracket, which is under $18,200, and then the top bracket, but there are also other brackets in between there because it's a progressive system.
Exactly.
So can you explain how is tax done progressively?
Okay, so for the first $18,200 you earn, you don't pay any tax. So think
Everyone.
Exactly. So think of all of these dollars as individual dollar coins. So you don't pay any tax on those first $18,200, and that's the bottom tax bracket. But then any dollar you earn above that point gets taxed. So from July, the tax you pay above $18,200 starts at a rate of 16%, and it eventually reaches 45% for every dollar, think of those coins, earned over $190,000. So importantly, let's just say that I'm earning $80,000 and that would be in the 30% tax bracket. That doesn't mean that I'm paying 30% tax on $80,000. It means I'm going to get taxed nothing on the first $18,200. Then every dollar earned between $18,200 and $45,000 is taxed at a rate of 16%. And then every dollar earned between $45,000 and $80,000 is taxed at 30%. Does that kind of make sense to you?
Yeah, so as the income goes up, you progressively get more tax. But I don't know if you've ever heard that misconception that you never want to be earning just above a tax bracket. So let's say you never want to be earning above or just on the cusp of $120,000 because that means you're going to be paying way more tax than if you were just below it. But that is completely wrong. That's a complete misconception, right?
Exactly. And just keep thinking about those dollar coins. So if you're just over the tax bracket, you're only paying the higher tax rate on that dollar that you're over. Everything else underneath is taxed at the appropriate rate.
Okay, so let's just say you're on $45,000 and $1. You're only paying 30% on that $1 above $45,000.
Exactly. So every dollar you earn above 45 would be at that 30%. So that's 30 cents of every dollar. So if you're earning $45,001, you're just paying the higher tax rate on that single dollar.
Got it. And so the next question we received is, what does ticking the tax-free threshold mean, and why are second jobs taxed more? Let's answer the first one first.
So this is part of the form that you fill out normally when you get a new job. And if you tick a box on the form that says, yes, I would like to claim the tax-free threshold, it means you're not going to pay tax on the first $18,200 in that job. And so when this comes in as important is when you have more than one payer, so more than one job, because you can only claim the tax-free threshold from one payer. And usually you claim the tax-free threshold from the payer who pays you the highest salary. But if you do tick both, it means you're most likely going to have to pay some money back to the ATO at the end of the financial year, because basically you've been double dipping on that tax-free income offer, essentially.
Right. But when it comes to the second job, it's actually a misconception that you get taxed more for a second job, because it's not about where the income is coming from. It's just about how much you are earning.
That's a misconception, right? And you don't pay extra tax for having a second job. So if you're earning $1,000 a week, it doesn't matter if you're earning that money from one job or 5 jobs, you'll be paying the same amount as tax as someone who earns it from one. But it may feel like you're paying more tax on the second job because of how that tax-free threshold works. So on one job, that payer is not withholding tax on the tax-free threshold for you. And on the second job, they are withholding that tax, which means on the second job, there might be less money in your pay packet. But at the end of the day, it comes down to what your total income is. So think of your name and one figure. That's what the ATO is seeing. And there's no penalty at all for having a second job when it comes to tax.
That makes total sense. So it's about to be tax time. Why do we get some money back? Which not everyone gets money back, but for those who do, why?
So in most cases, you're going to be taxed the right amount by your employer. And if you don't have deductions, and we'll get to that in a sec, you're not going to get anything back in your tax return because you've been taxed the right amount by your employer, and that's all kind of automated for you. But if you receive money back at the end of the financial year, that's because you've paid too much tax through the year, and the ATO calls that a tax refund. So if you're working in a full-time job, like you're full-time at the Daily Aus, your employer, so me, we pay your tax for you throughout the year. And that's called the pay-as-you-go tax system. And there's a whole heap of reasons then that you could then look at your tax return and get some tax back. And the most common reason is because of deductions that you've claimed for work-related expenses. You can also get some money back if you change income during the year, or there might be some mistakes in the way that tax is withheld by your employer. There's a whole variety of reasons. The main one is deductions, though.
You've mentioned that word deductions a few times now. Can you just explain what do you mean by that?
So this is something that does lower how much tax you have to pay, and it's usually a work-related expense. And the idea here is that if you claim it, that expense is deducted from your income, and that can mean that you might get some money back from the tax office. And there are so many categories of things you can claim as work-related expenses. And the ATO on their website actually has occupation-specific guidelines for common work-related expenses. So I looked up what it could be for you if you're a journalist, and it could be the cost of hiring a camera when we've asked you to go and film a piece somewhere exotic.
It can even be things like if you work from home, for example, you can claim a partial amount on the internet, on your Wi-Fi bill.
Exactly. And for all of this stuff, I really recommend talking to an accountant or a financial advisor, or at the very least reading on the ATO's website their guidelines, because it can get a little bit tricky. But it's also a misconception, and I've heard this from quite a few friends, that you can get back the full amount that you spend. That's not true. So if you spend $1,000 on work-related expenses, so deductions, and you're in that 30% tax bracket, the tax benefit is only going to be 30%. It's $300. So you are still going to be out of pocket $700.
Right. And is there a maximum amount that you can claim?
So you're talking about if you're hiring, thousands and thousands of dollars worth of cameras to film the piece that we've asked you to film in Tahiti. There can be.
I would go to Tahiti. I'm waiting for that request.
That's a nice tax deduction. It depends on the category and the nature of what you're claiming. For example, in terms of the maximum amount you can claim when you donate to charity, so donating to charity is a tax deduction, you can't claim more than your income. So in other words, you can't say that you had an annual loss, you earned $50,000, but you donated $55,000 because you donated more than you earned. So that's just one example, but in every sort of category and occupation, there's different guidelines, and it's really important. I think the most important thing here is you need to have proof of what you did.
But there are often maximums from what I understand. Even the example I said before about the internet bill, you can't claim all of that.
Hello, I'm James, and I produced the video you're watching. If you're enjoying what you're watching, we'd love it if you considered subscribing and checking us out on our other platforms. It'd really help in getting the word out about what we're doing here at TDA. Thanks very much, and now back to the deep dive.
So the ATO is given kind of a mathematical way to work out how much you can claim. It's the same thing as petrol if you're driving a car to perform your work duties.
Yeah. Next question. Can I still get my tax return money from a couple of years ago?
Yeah, so I'm imagining the moment where this person who asked the question on TDA logged into their ATO and saw like 3 or 4 years of tax returns that haven't been done. Maybe they were at uni, they didn't understand that they needed to do it. You actually do have a legal obligation to lodge a tax return. Even if you're not due a refund, you still need to get it in. And the ATO ideally always wants you to file that tax return before the 31st of October of that year.
So that's 4 months after the end of the financial year?
Exactly. So our financial year is ending in a couple of weeks on the 30th of June. And they want you to get it in by the 31st of October. And if you do that, you're 100% going to avoid fees or penalties. And that's something we should talk about. I mean, the ATO can impose some penalties on you if you put in your tax return late, but there are also lots of different ways for you to ask for ways out of that penalty, explain why it took you so long. The ATO is always ready to understand what's been going on. Now, if you go to an accountant to help you with your tax return, you just need to engage with them before October 31. So you need to set up your appointment and start that process. But you don't actually necessarily need to do the filling out of the tax return with your accountant before October 31.
So just
you get a bit more time if you're going with an accountant.
So just to be clear, you've got 4 months if you're doing it by yourself. But if you engage an accountant, then you have a little bit longer as long as you engage the accountant before the 4 month deadline.
Yeah, but I think if you're listening to this and a little bit confused and you want like a super short takeaway answer, just do it by the 31st of October. That if you can do that, you're in a safe place.
I think some people listening will think an accountant sounds great, but also we are in the midst of a cost of living crisis. They also sound expensive.
Well, there's a couple of things I'd say to that. I mean, one is it's going to be more expensive if you get fined, and it's going to cause a lot more emotional stress as well. But secondly, an accountant can help you identify areas of deductions you might not even know about, and they can really help you guide you through the process. Interestingly, also, the cost of seeing an accountant is a tax deduction next year. So it's a work-related expense in the eyes of the ATO. So I do think that it's worth, if you're feeling really overwhelmed and clueless, it is worth getting professional advice with this. Obviously, there's a cost to it. I know that this is a really tough time for Australians. So there's always ways to do it yourself as well. But that option's there if you can.
Now, another thing the ATO can do is they can conduct an audit. And one person asked, how far back can the ATO audit you? But before we get there, can you first just explain what is an audit?
So I've seen on TikTok recently this idea of asking for receipts. It's exactly that. It's literally asking for receipts, and it's a more intense examination of you as a taxpayer.
We have different FYPs.
I'm deep in dating FYP.
Right.
Happily married, but deep in dating FYP. So it's basically asking for receipts to make sure that what you've said is a work-related expense and you've deducted some of your tax for that actually happened. So, did you spend $100 on a textbook that you said would help you for your job when you claimed it as an education expense? Did you actually go to Tahiti to film a piece for us on climate change? Or was that a trip up the coast and you're not telling the truth?
So it's compliance, making sure that everyone is complying with the law.
Exactly. And if you have done the right thing, there's nothing really to be scared of here. Now, in terms of a time limit, how long should you be keeping these receipts for? There's no actual written time limit for how far back the ATO can audit you. But in terms of how they typically work, you can expect to be notified that you've been audited within 2 years of the date of assessment. So that's normally the end of financial year. That's for individuals and small businesses. And medium to large businesses can expect one within 4 years. Now, one other really important point, if you get a notice that you're being audited, it doesn't mean you've done anything wrong. It might be totally random. It might be just, you've kind of drawn the lucky number in that year's lotto and they just want to go a little bit deeper.
Think of it as like the RBT.
Exactly. That's a really good comparison. And so as a guiding rule, I'd keep receipts for 5 years. I mean, it's pretty easy now that most of our receipts are online. So I've got a little folder in my Gmail account that's got every year's receipts.
Wow, way to rub it in that you're organised.
Well, there's a reason that I'm explaining. So I keep them for 5 years after I've lodged a tax return.
All right, next question. How important is it when you're only just 18 and you make very little money?
Well, I think you should shoot for the stars. Any money you earn is important, and I think the sooner you can get started in the workforce, good on you. But the key here is not about your age. I mean, it doesn't really matter how old you are. It's about how much you're earning.
Okay, next question. Now, this is a big one. Why do individuals pay more tax than some companies?
Oh, Billy, this is one that really gets people fired up.
We often talk about this.
Yeah, and so there's this idea out there that large corporations avoid tax. And that they're doing so legally, which is a bit weird. I mean, it's not always legal, but there is this idea that they've figured out ways to get around the tax system.
A loophole.
Yeah, and we could honestly spend a whole podcast talking about this. And I actually really understand how frustrating it is to look out onto these massive companies and see they're not paying tax. And then you're earning, 50 grand and paying tax on that. So essentially, individuals are taxed differently to companies like a big bank or a big supermarket or a big mining company or a big tech company. And that's basically comes down to what the government has decided is needed to keep the economy moving, growing, and relatively fair. So companies are taxed at a flat rate on their profits, so how much they're making minus how much they're spending. And that can be reduced through various deductions, tax credits, government incentives, a whole range of things. I mean, there's full-time jobs dedicated to helping companies lower their tax rate. But individuals, on the other hand, are taxed on a progressive scale, as we've talked about, based on their income. So profits versus income, that's really the difference.
Right. And the difference there is that profits is once expenses are deducted. And if the expenses deducted means that you're in negative, then you're not paying tax.
Exactly. So if your business makes a loss in a financial year, then you won't be asked to pay tax on that loss.
Got it. Okay, next question. We're moving along quickly. If you make a little mistake in a tax return, will you end up in jail?
Oh, gosh. I've had sleepless nights thinking about the police banging down my door because I've accidentally, done something a day late or that kind of thing. No. I mean, making a small mistake on your tax return is not going to land you up in jail. The ATO takes an approach that mistakes happen. And even if they do find a mistake in your tax return, they typically allow you to amend that. They'll give you a notice saying, we've noticed a discrepancy. Would you like to adjust it? It's a very different case, though, when you're coming across instances, and these are the ones that you and I talk about in the news, of deliberate tax evasion or fraud. And that can result in severe penalties. You can go to jail 100% for tax crimes. So the golden rule here is if you've been notified of an error by the ATO, they're not about to come to your house and arrest you. You just need to fix the error and go about it in the quickest way possible. Then, if you're in doubt, still go and speak to someone. Go and speak to an accountant because, there might be then a penalty in play. It's going to be cheaper. It's going to work out cheaper to get some professional advice.
So what I'm hearing is the big difference there is intention. Did you intentionally make a mistake? In which case you may be in trouble.
Yeah.
Obviously, I think you would be in trouble. But if you didn't intentionally do it, then it's more likely that they will be fine with it and it's just a case of amending it.
Exactly. And I know you're a good person, and I know that good people like TDA listeners, they always don't mean to make the mistakes. So just fix it up and move on.
Okay, last question, and we did touch on this briefly before, but someone asked, do you need an accountant?
Well, I think, so this has come up a couple of times in our chat, and it's a weird one because, yes, like an accountant is fantastic. And their job, they've studied for years and years to help you get the most out of your tax return. But you don't necessarily need one. And especially if you can't afford it, it might not be a reality. But if your tax situation is complex, so if you fall into that category of having a few different jobs, if you have, different family wealth situations, if there's properties involved, if there's overseas accounts and travel and government allowances and job seekers and whatever, it can help to really make sense of everything and to work out what you can still claim. So when you go and see an accountant, you sit down and they make sure that your tax return is accurate, but they also then identify where you could perhaps getting some more money back, what government programs you might be eligible for. And again, as I said, the actual cost of going to see an accountant is a tax deduction itself. So you can claim that the year after. And at the end of the day, this is not meant to be a hugely stressful period of life. It's meant to be kind of a form that we have to fill in at the end of the year to make sure we're part of a growing country.
Great. I feel so much more informed. This feels like a classic example of one of those things that we weren't taught in school, but definitely should have been. That 100%. Sounds like a biased opinion, but it's just crazy that we are just expected to know this.
I do think there's a whole series of examples like a tax return of things that we just should have learned.
Sam, thank you so much for explaining.
Thanks so much, Billy.